Picture this. You pull $25,000 from your IRA to finally take that Alaskan cruise you and your spouse have been talking about for years. The trip cost what it costs, but the IRS decides that withdrawal looks more like $38,000 in income once everything gets added up. Your tax bill climbs, your Medicare premiums jump the following year, and that one vacation ends up costing you far more than the price of the tickets. That's the part nobody warns you about, and it's completely avoidable if you know which accounts to tap and in what order. Over the next few minutes, you'll see how to line up your income sources so you keep more of what you saved, how the tax code treats IRA withdrawals, Roth accounts, and brokerage sales very differently, how to sidestep 3 landmines that catch retirees off guard, Social Security taxation, Medicare's income-based surcharges, and required minimum distributions that can snowball into a real problem by your mid-70s. And to ground all of this, you'll follow a real-world example of a couple in their late 60s and see how simply changing the order of their withdrawals adds years of extra spending power. Stick around for the final section. It's a short yearly checklist you can keep tucked inside your tax folder and actually use. For most Americans heading into retirement, income comes from a handful of places: Social Security, a pension or annuity if you have one, tax-deferred accounts like a traditional IRA or 401k, a taxable brokerage account, and tax-free accounts like a Roth IRA or Roth 401k. Social Security and pensions are the predictable part. They show up every month regardless of what the market does. Everything else is under your control. Your job becomes building your own paycheck, covering the gap between what those fixed sources provide and what you actually want to spend. Most people stop there and ask which account has the most money. Then they pull from that one. That's precisely how retirees end up handing more to the IRS than they needed to. Before you touch any account, you need to know where the traps are. The Social Security tax torpedo. Social Security isn't automatically taxable, but it can become taxable depending on what the IRS calls your combined income, your adjusted gross income, plus any tax-exempt interest, plus half your Social Security benefit. For married couples filing jointly in 2026, if that combined figure stays under $32,000, your benefits aren't taxed at all. Between $32,000 and $44,000, up to 50% of your benefits can get pulled into taxable income. Above $44,000, that number rises to 85%. Those thresholds haven't moved since the 1980s. They were never adjusted for inflation, which means a growing share of retirees cross them without realizing it. A single extra IRA withdrawal of $3,000 can suddenly make a chunk of your Social Security taxable, and what felt like a modest tax year turns into something much worse. Medicare IRMA surcharges. If your modified adjusted gross income from 2 years prior exceeds $106,000 as a single filer, or $212,000 for a married couple, your Part B and Part D premiums start rising in tiers. These surcharges can run several $100s per month per person, and they kick in even if you exceeded the threshold by a single dollar. The 2-year look-back makes this especially tricky. A large Roth conversion, or IRA withdrawal at 67, can show up as a Medicare premium surprise at 69. Required minimum distributions. Once you reach your early 70s, the IRS requires you to pull a set amount out of traditional IRAs and 401ks every year, whether you need the money or not. Those withdrawals count as ordinary income. The larger the balance sitting in those accounts when RMDs begin, the bigger the forced distributions, and the more likely you are to trigger the tax torpedo and RMA at the same time. What you do in your 60s has a direct effect on how painful your 70s look. Taxable brokerage accounts. When you sell investments held longer than a year, you pay long-term capital gains rates. In 2025, married couples filing jointly can realize up to roughly $96,700 in long-term gains and qualified dividends at a 0% rate, provided their other income is low enough. Traditional IRA and 401k accounts. Every dollar that comes out is taxed as ordinary income, exactly like a paycheck. For married couples in 2025, the 12% bracket runs from about $23,850 and $96,950 in taxable income. The The 22% bracket picks up from there through $206,700. Roth IRA and Roth 401k accounts. Qualified withdrawals are completely tax-free. They don't factor into the Social Security combined income formula and don't affect IRA calculations. $1 from a traditional IRA can simultaneously push you into a higher bracket, make more of your Social Security taxable, and nudge you toward an IRA tier. The same dollar from a Roth does none of that. The question isn't just where the money is. It's which dollar does the least damage on the way out. Every situation is different, but most retirees with a mix of account types tend to benefit from some version of this sequence. First, draw from taxable brokerage accounts and cash. Second, do controlled IRA withdrawals and Roth conversions up to a target bracket. Third, delay Social Security as long as reasonably possible. Fourth, protect the Roth and leave it for last. The years from 60 to 70 are the planning window that most people waste. Your paycheck has stopped or dropped. Social Security may not have started yet. If you're under 63, IRA isn't a factor yet either. That means your taxable income is often lower in this window than it will be in your 70s, when RMDs and full Social Security benefits are both in play. In these years, the typical approach is to cover most living expenses from the taxable brokerage and any cash savings, then add enough traditional IRA withdrawals or Roth conversions to fill up the lower brackets without triggering unnecessary Social Security tax. Leave the Roth untouched and let it keep compounding. The goal is to spread your tax burden across your lifetime, not chase a zero tax year in your 60s and walk into a punishing bill in your 70s. Robert is 68, Carol is 65. They retired recently and want to spend $95,000 per year after taxes. No pension. If they claim Social Security now, they'd receive a combined $52,000 annually. If Robert waits until 70, his benefit rises substantially. Their savings, $450,000 in a taxable brokerage account, $850,000 in traditional IRAs and 401ks, $200,000 in Roth IRAs. Both are healthy, expect to live into their late 80s, and want to leave something for their 2 adult children. Phase 1, before Social Security begins. Robert delays until 70. Carol claims at her full retirement age. For a few years, all income comes from savings. Each year, they pull a large portion of their spending from the taxable brokerage account, realizing long-term capital gains that mostly fall in the 0% band after their standard deduction. They add enough IRA withdrawals or Roth conversions to bring taxable ordinary income close to the top of the 12% bracket, sometimes a bit into the 22% bracket if the math still makes sense. The Roth stays untouched. By doing this steadily, Robert and Carol are quietly draining the account that would otherwise force large, fully taxable withdrawals in their 70s, instead of the IRS dictating how much they pull, and when they're making that decision now, at lower rates, on their own timeline. Phase 2. After Social Security starts. Robert's benefit comes in at a higher monthly amount because he waited. Carol's has been running for a few years. They now have a strong fixed income base, so they need much less from savings. At this point, every extra IRA dollar they withdraw can make more of their Social Security taxable, because those combined income thresholds at $32,000 and $44,000 don't move. So the order shifts. First, take RMDs from traditional accounts. That part is non-negotiable. If they need more than Social Security plus RMDs cover, they fill the gap from the taxable brokerage, staying mindful of long-term gains rates. The Roth is the reserve. It comes out only to avoid jumping a bracket or crossing an IRA line, or to cover a large one-time expense like a home repair, a new car, or helping a grandchild with tuition, without pushing their income somewhere painful. The accounts are the same. The order is different. The lifetime tax bill is materially lower. Don't drain one bucket completely before touching the next. Blending across accounts, guided by bracket and threshold awareness, almost always beats the simple sequential approach. Use your 60s to shrink future RMDs. If you can fill the 12% bracket and carefully dip into the 22% bracket now, using the 2025 thresholds, you're paying modest taxes today to avoid being forced into higher ones later. Watch your combined income relative to the Social Security thresholds. Know whether that extra $4,000 IRA withdrawal is going to make an additional chunk of your benefits taxable. Sometimes the answer is yes, and it's still worth it. But it shouldn't come as a surprise. Before age 63, Roth conversions are often the best deal you'll get. That's the window before your income starts affecting Medicare premiums 2 years down the road. Let the Roth grow. Save it for flexibility in your late 70s and 80s, for large one-time expenses, and for heirs. Qualified Roth withdrawals don't show up in taxable income or IRA calculations, which makes them the cleanest dollar in your entire retirement picture. Once a year, sit down with your tax return and walk through this. Write down your fixed income for the coming year, Social Security, any annuity payments, rental income, part-time work. Decide what you want to spend. Be honest about travel, home projects, family expenses, whatever is actually planned. Calculate the gap. That's how much needs to come from savings. Pick a target tax bracket. Know roughly where the 12% bracket ends and the 22% bracket begins for your filing status under current law. Fill the gap in order. IRA withdrawals or Roth conversions up to your bracket ceiling, without triggering unnecessary Social Security tax or crossing an IRA threshold. Then brokerage funds, aiming to keep gains in the 0% long-term capital gains range. Roth only when you need to avoid a jump in taxes or premiums. Check in mid-year if something changes. A property sale, an inheritance, a major medical bill, any of these can shift the right answer. The first couple of times you do this, it takes some effort. By the third year, it's just a rhythm, like any other financial habit. The order you withdraw from your accounts can matter more than the specific investments inside those accounts, at least once you're already retired. That's not intuitive, which is why most people skip it. But a dollar pulled from the wrong account at the wrong time doesn't just cost you the tax on that dollar. It can ripple through your Social Security calculation, your Medicare premiums, and your future RMD size all at once. This is education, not personal tax or legal advice. Your specific situation depends on your state taxes, your health, your filing status, and how your savings are distributed. A fiduciary financial planner or tax professional who specializes in retirement income can help you run the numbers for your exact picture. If you found this useful, share in the comments what mix of accounts you're working with. A future video can walk through examples that look more like your situation. You spent decades building these savings. It's worth spending a little time making sure you pull from them the right way.